Hello and welcome to the Investment Appraisal lesson. Please note that Investment Appraisal is basically evaluating the profitability and desirability of an investment project. Let's get started.
So, payback period. I'll start talking about first the definition of a payback period, then I'll explain it, and then I will give some examples, and finally I will talk about the benefits and the limitations that come with it. Well, first of all, how can a payback period be defined? A payback period can be defined as the calculation of the length of time that it takes for a capital investment to pay for itself using annual net cash flow provided by that investment. Basically, how much time does it take for my investment to pay for itself? Now, starting by giving a dumb example of, let's say, I don't want to go work, I want to stay at my house and watch Netflix. But I want to gain money and I already have some money. So what I could do? I could buy a cutting grass machine and then I could pay someone to go at other people's house to cut grass using my machine. How will I calculate the payback period? Well, in the payback period, I have like the price of the machine will be like some number there, and then I will have like the net cash flow, which will be the cash inflows minus the cash outflows. So, what will be the cash outflows? The cash outflows will be, let's say, the person that I will be paying to use my machine and whatever like complications that come with my machine, like let's say that something breaks in it and I have to fix it, or I don't know, maybe it needs oil or something like that, that costs money, and that will be my cash outflows. And my cash inflows will be basically the money that I will be earning by the person using my machine. So to get the net cash flow, I will get what the amount of money that I'm earning minus the cost that is coming with the machine, and I will have some money left, and I will basically like calculate how much time I will need to use my machine to get enough money from the net cash flow that my machine can pay for itself, and then I'll start to gain money instead of still be paying for my money. So I'll give an example with numbers because maybe it's easier to explain. So let's say that I buy a machine for like whatever reason. Obviously the reason is to gain money. But let's say I buy a machine, the machine costs $200. So what will happen is in my first year the net cash flow will be minus $200, because if I calculate that the cash inflow, like how much money I will get for my machine, will be nothing because like I just bought it. And then the cash outflow will be 200 because this is the price of the $200,000 because this is the price of the machine. So my net cash flow will be minus $200,000. And then in my first year, let's say that my machine gives me $80,000, but paying the workers and everything that went wrong, I lost $20,000. So I will calculate about $80,000 minus $20,000 to get $60,000, which will be my net cash flow. And so I'll start already by getting the minus $200 and doing it minus $200,000 and doing it plus the $60,000, which will give me a negative $140,000, which will be the price that I still need to pay, that my machine still needs to pay for itself. Then I will get, let's say the second year is I gain $140, but I had to spend $60,000. And so what happens is I will need to get $140,000 minus $60,000 to get my net cash in my net cash flow, which will be basically $80,000. So I will get my one minus $140, which was from still remaining from the price of the machine, and I will do that plus $80,000, which will give me $60,000. So what happens with the $60,000 is that will be negative because I still need to pay this $60,000. Well, then in year 3, I gained $240, but I had to spend for the machine, let's say $120,000. So now I have $120,000 as my net cash flow, which is like actually what I got. And so I need to get a minus 60 and do plus $120,000, which will give me now finally a positive number, which I will get $60,000. Finally, I will start gaining my money back. But now, how I will calculate exactly when the machine gave me enough money, like to pay for itself? Exactly when? Because like it's a year, but like a year have many months, and we don't know exactly which month it was. So how will I calculate this? To do this, I have to do mathematical equation, which is my payback period will be equal to the amount left to pay divided by the net cash flow in that year times 12, because there are like 12 months in a year. So let's say at that time I had to do like to pay $60,000, and what I gained was $120,000. So I had like basically minus $60,000 divided by $120,000. But we'll make it positive because like now it doesn't matter. So what I will get one half, and then I will do one half times 12, because 12 is the number of months in a year, and I will get basically 6 months. Though I know that it took 6 months to pay itself in that year. So basically I can say that in year 0, year 1 I still needed to pay for it, in year 2 I still needed to pay for it, and finally in year 3 the machine paid for itself, but it didn't pay like it didn't took the whole year for it to pay for itself. It took 6 months in that year, which is like half the year for the machine to pay for itself. So I can say that the payback period for this machine was 2 years and a half. Now let's talk about the benefits and the limitations. So the benefit is that it's easy to organize yourself and your company to see how much money you will gain and how fast it will be, so that you can decide when to just change your machine and what machine to use. And the limitation is basically that money loses value over time. So you in theory you get your payback, but maybe like the money that you spend now isn't exactly the same as the money you will spend like after 5 years. Let's say okay, now I have like $5 and I can buy a hamburger from this store, but after 5 years the store will be asking me for $10 for the hamburger. Obviously not, but like maybe $10 for this hamburger, because money loses value over time. So this is the main limitation, and this payback period calculation doesn't take this in consideration.
Well, to understand what is the average rate of return ARR, we first need to understand a series of factors. We will first start out by getting familiar with the term ARR, or average rate of return, and what it stands for. Basically, by the end of it, you can explain what ARR is. Then, we will approach on how does it work, giving a theoretical brief explanation. And then we will analyze which are the best advantages of this approach and disadvantages. So then, we can get started with a real-world project by calculating the average rate of return and determine which projects are worth it. Okay, so first, what is the average rate of return? Well, the ARR is a method of investment appraisal that allows the business to measure the annual profitability of the initial investment in the future, meaning that you can calculate the real value of an investment based on the profitability that it generates for your business. With that in mind, note that average rate of return can also be referred as accounting rate of return. With that in mind, the ARR is a great tool to determine which projects would be more profitable in the long run. Okay, and how does that work? To get going, we need to follow a plan which approaches the pricing of certain objects. To understand it better, grab a piece of paper and write. Well, the annual profit, which in this case will be the net cash flow over the initial capital cost, Now times that by 100. What we are doing here is basically setting up the calculation to the over total profit over the lifetime of the investment. Then we're going to divide this by the number of years of the project. And finally, we're going to divide this by the initial costs of the project. Now that we get to know what is the base of ARR, we should definitely talk about the advantages and disadvantages of this project. Let's begin by explaining what advantages the average rate of return applies when a real project is done. I will start out by saying that when a business is built, the owner is most likely wanting to gain money, to maximize the profits, to make the most out of its business. Well, by using the ARR, profitability is the main focus here. But what will be more profitable, Project A or Project B? Well, by using ARR, we can figure that out too. The second benefit is that ARR is flexible with projects head-to-head comparisons. You can put two investments opportunities back to back and decide which one suits the company's needs better. Also, ARR takes in consideration the net flows for the expected lifetime of the project, meaning that whoever is investing will also be able to see predicted values for the cash outcomes too. This is possible to predict money losses after XXX lifetime of the object. We can understand and expect when will the net flows neutralize. But do not think it's only a sea of roses. Everything has its downsides. So that is also why we are going to talk about the limitations that come with ARR. First, there's one thing that should be noted. ARR does not take in consideration time as accurate as the other two methods. Well, it ignores the timing of the cash flows. This could result in two projects having similar ARR results, but in reality, one could pay much more quickly than the other. Also, pricing forecast, meaning the plans of the future prices expectancy. If they're wrong, then you're in trouble. The third thing is that also ERR literally ignores inflation, meaning that whatever plan you made in today's money inflationary data is not very accurate. It is static, meaning that even if you're planning for the future like 2030, the inflation rate is static to when you started the plan, meaning profits are lower than you expected, something a business cannot afford to do. Now, let's say that you have like a dancing robots company for whatever reason and you need a supplier. Well, you can either buy one big robot from Boston Dynamics or 10 little robots from Now. Now, let's say the Project Y is the Now little robots and it costs around $80,000. If one breaks, you can still keep operation and neutralize the cash flow faster in about 4 years. Now, in the other hand, you have one big Boston Dynamics robot which would take longer, about 5 years to pay itself, and if it breaks, you stop completely make money. But then your plans should look something like this. Now it's your chance to do it. To calculate the ARR, remember, annual profit, which is the net cash flow, over the initial capital cost, times 100. Now do it!
Okay, so now we'll be talking about the net present value. I like to view this net present value in a funny way. I like to view it as the cumulative net flow but in steroids. Why? First of all, I will now be using a discount rate because I understand that money loses value over time. I will take this now into consideration. And with that, I understand that the money that I will get won't be actually valued the same amount as it was before. So let's say that I have $100 now, 2021, and I don't spend it and I only want to spend it in 2022. Well, if I have an inflation running at 2% in 2022, it will be valued as $98 dollars worth of goods. The same thing here. So in my last slide talking about the payback period, I use an example of a cash inflow and cash outflow, of the cash inflow being $80,000, the cash outflow being $20,000, and then I will be having a net cash flow of $60,000. For you who don't remember how I got this, the cash inflow is how much money the machine or investment will give me. The cash outflow is how much money I will still need to spend for the investment so that it will work. The net cash flow is basically I will be getting the cash inflow minus the cash outflow. So let's say I have the cash inflow of $80,000 minus the cash outflow of $20,000, I will get $60,000. But now I have to put the discount factor. So let's say it's like the inflation is running at 2%. Well, now this value of the money won't be $60,000. It will be $58,800. So this is now what I need to take into consideration. So when I have my cumulative net cash flow, I won't take out $60,000. I will take out $58,800 to get my net present value, which now it will tell me exactly when my machine will pay for its value. Not for itself, but for its value. Because when I was talking about the cumulative net flow, I would know when the machine will pay for itself. So I believe it was like it will take 2.5 years for the machine to pay for itself. But when we take into consideration how much the money loses its value over time, now we know that it will take a little more. And we will do this by using the discount rate to do it times the net flow. I will do the present value plus I will just add the present value to be gaining the net present value. So I said that I had a cash inflow in the first year of $80,000, and then the cash outflow was of $20,000, and the net cash flow was $60,000. So during the minus $200,000, which was the value of the machine, plus the $60,000, I know that my cumulative net flow was of minus $140,000, which means I still need to pay $140,000. The machine still needs to pay $140,000 to pay for itself. Still needs $140,000 for it to pay for itself. Well, now we know that not exactly when it comes to value, worth of goods, because the present value won't be $60,000. It will be $58,800. It will be $141,200. And now, using this, I can now tell you when exactly the machine will pay for its value, using the same equation as before, but with the discount factor. So the main disadvantage of this is because it's a little bit more complex than the other one, but it will permit the person to have more knowledge of what's actually happening with the money. Okay, so now talk about evaluation of investment appraisal. Well, so first of all, what are the methods of investment appraisal? We have the quantitative techniques like payback period, average rate of return, and net present value, as I said before, which basically I will have an idea of like how my product will be successful in, or like pay for itself in, when it comes for money or value. But then I have the qualitative techniques, which is basically I don't actually have an idea of when the product will be able to pay for itself or give me money, but I already have a good feeling about it because I'm using the qualitative techniques like the product life cycle, which is the product in the growth or maturity phase. If the firm believes that sales are going to grow rapidly in the future, then investment should proceed. Then we have also like the Boston Consulting Group BCG matrix, which products that are deemed to be stars are predicted to have a bright future, so will normally be priorities for investment funds. And then we have like steeple analysis, which is basically saying that results from external analysis may point to future opportunities, and it is important to consider the level of risk when an economy is growing or not. Then we have the product portfolio analysis, which says that this may point towards a gap in the product portfolio that needs to be filled with investments in new products. And we have the market research results, which basically saying that results from interviews or focus groups may point towards a growing market that could be targeted. So these are like the main ideas of the qualitative techniques. So I will basically be using in the quantitative techniques like information that I already have from the machine itself, and while the qualitative techniques I will use information around the machine or my investment. So this is basically the main difference.
So now that you have captured all this information, you can say with certainty that now you understand what investment appraisal is. With that in mind, thank you for watching.